and welcome to the show. Money is something that everybody talks about, thinks about, just about all the time, whether it be in the day, when you're sleeping, you have nightmares about it sometimes. We never have enough of it. We're always trying to find out how to get more of it. We're going to try to shed some light on the whole money picture with a financial consultant, Earl Beecher. He is going to be talking to us. He's a professor, and if you have read the Night Ritter newspapers for a long time, remember a column called The Money Doctor? Well, we have the money doctor, the doctor himself, Earl Beecher. We're going to talk about many aspects of money, finances, and a little about public finance as well, which I think you're going to find very interesting. Earl, pleasure to have you.
Thank you, Bob. It's a pleasure to be here.
Now, the term financial consultant, what does that mean exactly? How can people relate to that?
It fits in many places. A lot of my students at the university would ask me, if I major in finance, what kind of a job does that lead to? Do I work in a bank? Do I work in an insurance company? There's a lot of places. Every company in the world needs a finance function performed. They need to know whether they're doing well or not. And also every person in the world needs a little financial planning. And lately I would say most government agencies could use a little financial planning as well. So when we say this, with government, we're talking about federal, state, county, city, district. So we cover a multitude, and we will get into that in the latter part of the show, I hope, Bob. For personal, we have to do some estate planning for people. We talk about doing things like their real estate holdings, their insurance holdings, stocks and bonds, commodities, if any, like gold or hard money, and retirement planning, tax planning. There's just a lot that people need to do. And for companies, we worry about whether they're solvent and profitable. Those are the two words I kept telling the students. If there's two words I want you to know, it's solvency and profitability. You've got to know how to read a spreadsheet, how to look at a company's reports and see if the company's getting stronger or weaker. And you can tell which ones are doing better gradually and which ones are doing worse and what could happen. And also then there's the planning, the budgeting, and finally even capital budgeting. And then where to go to raise money.
So many aspects of that.
Many.
By students, you taught this for many years, about 30 years or something at Long Beach State, right?
I was at Cal State Long Beach for 33 years, and I've also taught 3 years at UCLA and part-time at UC Irvine, CSULA, and Pepperdine. So I've been around, yes.
And you taught all of these aspects that we were just talking about, right? Personal, financial analysis, all of those things.
Oh, if you don't mind, I can give you a list of some of the courses I taught, which is business finance, business financial management, and then financial institutions in the money market. And this would get into the area where the mutual funds are functioning, where the banks are functioning, the economic profiles and so forth, and the stock market in particular, then investments, which is a general introduction to the overall field, then security analysis, where you dig in and do an analysis on a single company's stock, so you know whether this company or this industry is doing well or not. Then the capital budgeting, which was the long-term plans. In other words, a regular budget is usually within the next year to 18 months. For a capital budget, are we going to buy this production facility or not? Are we going to merge with this company or not? Big plans. And then
a lot of companies get into trouble when they don't have those plans too, don't they? Is that why there's
there are things that can jump up and bite you that you don't expect. For example, one big company merged with a small company. The small company had an excellent retirement benefit plan for their employees. All of the employees of the big company said, hey, we want this just as good, because in the merger agreement, the big company had promised the smaller one, we will honor that retirement plan and keep it in place. Well, when it came time for all of the employees of the big company to get equivalent benefits, the company couldn't report any profits for the next 9 years. It took them that long to catch up to where these people were, and they hadn't seen that one coming. They were just blindsided by that. So there's a lot of things that when you get into mergers and so forth, it can be very important. The capital budgeting that goes on. My favorite class was the forecasting class. This is fun, where you're looking to the future and you're trying to say, okay, what's going to happen? At one time, I had my students do a forecast of every city in Orange County and half of the cities in LA County, all the ones in the southern half, which were within what I would say the California State University at Long Beach service area, where most of our students came from. And so we were looking at the city growth and seeing where the activity was, looking at the retail sales, the construction of private single homes or multiple dwelling unit homes, and additions, alterations, all of this kind of stuff to show what was going on in the city and where the growth was and where the growth was going to be. Then we extended it on out into Riverside and San Bernardino counties and Ventura County and San Diego County. It was very interesting. Back in the 60s, we had the growth rate of Orange County, and we did Ventura County and discovered it was 11 years behind Orange County, but on the same curve. And also that Riverside County was 13 years behind. Some of my students were smarter than I. They went out and bought land and did real well, you know. So they were taking their courses seriously. Also, I like to get into the area of public finance, which deals with the governmental aspects. Public finance deals with government finance. And then we studied risk management and insurance, and life insurance, health insurance, property and casualty insurance. So there's just many fields in the area of finance where people are doing more specialization now.
Yeah, and many people touch on these in their personal budgets and things, but usually it seems like they're going from day to day just trying to keep up with things and don't do the kind of planning they need to. So it's a really important aspect. And probably it's not taught enough in school, or people don't take the courses.
One of the things that really bothers me is I get calls from people with companies, and they have a program. And they're going to take you and force you into their mold. And I say, you really have to spend some time with the individual company at the top level, find out where they want to take this company. What are their plans? Where are they headed? Do they want to go international? Do they want to just stay local? What is their intent? And then the planning takes shape a little differently. Or if I were sitting down to do an estate plan with you, maybe you have a favorite child that you want to be sure is taken care of, and you don't want anybody else to know this. You get into very confidential things with people when you're starting to lay out their whole estate plan with them.
Yeah, and it's an area, too, living trust. There's so many things involved with it, and keeping your assets, if you want to keep it liquid, if you want to go through probate, all of those things, which are very complicated.
I did once teach an extension class on trust wills and estates. I didn't put that on the list here that I normally taught because it was kind of unusual. Some of the things I do not, or have not taught, really, are commodities. They are a special subject all in themselves. You know, you hear about people cornering silver or gold or wheat or corn or eggs.
That's a full-time thing, and I remember talking, I used to do a lot of radio programs with commodities people.
Okay, yes.
And people that talked about them a lot, and they said, you know, it's like going to Las Vegas. You take some money and you expect to lose it. So if you go in expecting to lose it, you're in better shape, because it's a very risky situation.
Well, about 96% of the people who invest in commodities lose it, but the other 4% get very well.
That's right. So that's where your timing aspect is very important, yeah.
Yes.
Certainly.
I did not teach real estate and international finance. I never thought I would get involved with international finance. And now that I have retired, I am getting very involved because I'm working with the Hispanic Business Association. We're starting to put trade programs together for people. Well, there's an upcoming big expo. It's called the International Fair, San Gabriel Valley International Fair, that I'm going to be working with people, and they've got people coming from all of the Pacific Rim countries and Central and South America and Mexico, NAFTA. There's just, oh boy.
I was just going to say, NAFTA is probably part of that too. That it's really
very clearly.
Yeah, it made a big impact on it.
So I'm making up for lost time now.
Sounds like it. Now, analysis. There are two kinds of analysis, right? Technical and fundamental. We're going to talk about that a little bit because there are some distinct differences and that people should know about.
Fundamental analysis is where we start, and that's what's usually taught in the classroom, and that is where you look at the company's income statements, balance sheets, retained earnings statements, and cash flow. And you look at these very carefully and preferably over a period of time. Now, This will then tell you which companies are gaining, which fundamentally are solid, who is in an industry that is an expanding industry versus one that's being replaced or becoming obsolete very fast. Technical analysis, after you know which companies are okay, then that tells you market timing, and it tells you when. There's a time to move in and a time not to. And so I will talk about some of the indicators of the technical analysis in a minute. But first, what I have my students do, or had my students do most of the time, we would pull a CompuStat tape information that was put out by Standard & Poor's. And from that, we would be able to get the balance sheet, income statement, and retained earnings statement information on the companies for 20 years. And so we would do a spreadsheet, a comparative financial statement spreadsheet, which would show, and you could see whether their sales were increasing or going down, whether their profit margin on sales was going up or down. One of the classic examples was a company called Douglas Aircraft in Long Beach, which was the biggest employer in our town where the university was. And their sales were growing magnificently. They grew from 10% to 19% of the total aerospace market in about 10 years. But what they did, their costs were rising faster than their sales because they were promising to make everything tailor-made, custom-made to the customer's desires. And as a result, the profit margin got squirrels and turned negative. And so they were losing money on each sale, but the sales were growing. And pretty soon they went insolvent. They just emptied their bank account, and they had to look around. And the next thing you know, there was a small company named McDonnell Aircraft, which came along, and it swallowed Douglas, and you had McDonnell Douglas. So,
so that was the
I won't
reason
say
for
the minnow
merger.
swallowed the whale, but it was almost like that. And it can happen that way in business. It's wild what can go on. And this is why mergers and things like that become an absolutely fascinating study.
Yeah, they do, and there are, you get little bits and pieces of this in the Wall Street Journal or some of the other publications, but it's long after the fact you need to know about it if you're going to invest in it, certainly. So
Yeah.
that's why if you're looking at things long before that, you're in a lot better shape.
In the fundamental analysis, I would get these comparative sheets. Then from that, we'd go to common size analysis, where everything was expressed as a percent. That way, I could compare DuPont to my little ice cream store to show a difference here. There was this wide a variety, and you could tell percentage-wise whose variable costs were big, whose fixed costs were big, relative to everything else, and put everything on a comparative statement. Then we had the ratios, and there's 6 major categories. The liquidity ratios, how solvent are they? The leverage ratios, how deeply in debt? It's interesting, most of the companies in the United States have been getting deeper and deeper in debt. When I first started teaching at Long Beach in 1961, if you had a debt ratio of 31% compared to your total assets, you were looked upon and frowned upon. And today, 56 is more the norm. So more companies are in debt. And this is one of the reasons why things are moving so fast and can get bad so quick.
Isn't that part of that whole merger acquisition frenzy that took place in the 80s? Wasn't that part fueled by that?
It could have a lot. I think the tax laws have a lot to do with it because there's an advantage. You see, if you earn a profit and you pay it out as a dividend, you get taxed as the profit and taxed as the dividend. But if you earn a profit but you pay somebody interest, then it reduces the profit. You only get taxed at one time.
Oh, I
and
see.
so the tax laws have encouraged American companies to get deeper into debt. As they did that, their leverage ratios got higher, and it made it easier to come in and buy the ownership segment. And so a lot of foreign investors moved in and took over American companies because they had less ownership to buy.
So is it a good trend or bad? Or how do you look at it? So you overall it's not a good...
Yeah, it's dangerous. It's more risky. And I always told my students, avoid risk. Avoid risk if you can. Then we had the activity ratios, which dealt with the turnover of the inventory, the turnover of the receivables, you know. The daily run-of-the-mill kind of things were featured there a lot. And profitability, which I've mentioned before, and the rate of return that the owners are receiving. And growth. How fast is this industry growing? Is this the fastest growing company in the fastest growing industry? Or is this the industry that's going downhill and this is the company that's sinking quickest? And that makes a difference what you do because you would react differently in the way you handle the stock. There's an advantage to both. You've got to know what you're doing. And finally, the valuation of the stock itself. So we'd take this CompuStat and put it through the computer and get the ratios and then the trends of the ratios. Then we would look at the changes in the overall balance sheet and then convert it to a use and source analysis. And then finally pull all of the stock market data, which would give us what's going on in the price of the stock and why. And you get a real feeling for that too. Now that's fundamental analysis. You can choose an industry as you go along. You find that certain industries are doing better than others. The hot industry, of course, has been the electronics industry, the computers, and it used to be hardware. It's become more software now. That's where the main growth is. The mainframes are pretty well constructed.
Yeah, pretty well put out by a few companies, too.
Okay.
Yeah,
So we have the fundamental tells you which company, and the technical tells you when to move. And what I'd like to just indicate is one thing. I found one of my students turned in a report one day. This company, I just saw green lights flashing all over the page. Man, this just screamed profits to be made if you invest now. And I took it to my associate I was working with. We were managing about $100 million, the two of us. And he looked at it and he says, oh, this looks just mouth-watering. This is good. But he says, not yet. I said, what do you mean, not yet? He said, the stock market hasn't found this one yet. When we begin to see this stock starts to be under accumulation, then we dive in and write it up. But it might sit there a year or two, and our investors would be sitting there saying, what are you doing? You're sitting on hold. Do something. And so that's what gets us into technical analysis.
And technical, then, is that it's the whole aspect of looking at companies from that aspect in order to know whether to hold on to them or buy them at that certain time, right?
Right.
What you're saying.
The
Whether to buy
timing
it.
becomes very important.
Now, there are people that do market timing in the stock market. They look at these kinds of things. And I've been told that they're successful maybe for 2 years and then don't do so well. It depends on who it is and what kind of a market timer they are. Because there are market timers for, what, bonds and all kinds of people, right?
Oh, there's market timing on everything.
Yeah, okay.
I stress this over and over to my students. There is no such thing as a safe investment.
Right.
You cannot put your money in it and ignore it. You have to
keep
watch
an eye on
it.
Yeah.
You have to watch it, and that's what is the key to the success. Could we take a break and then come back to the
Let's
technical
do that,
analysis?
Yeah. We'll do that. We'll take a break. We're talking to Earl Beecher. We'll continue in just a moment. The wonderful world of finance and money, trying to find out about how to take a look at companies, what makes them go, what makes them not do so well. We're talking about technical and fundamental analysis. We're talking about technical analysis now.
Yes, technical analysis has to do with the market timing. There's a time when you should buy. There's a time when you should hold. Just continue. It's called being in the long position. There's a time when you should get out, sell it, and there's a time when you could even short it. Now that means you borrow it, sell it, and then it goes down in price, you hope. Then you buy it back and return it to the person you borrowed it from. So you make money on the downside.
So there are people, so that's a good indication that people can make money both ways, going up or going down. Just take a look at what's going on.
But you've got to know which it's going to be and which way it should be. So you have buy, hold, sell, and short. And I hope that our friends in the viewing audience understand what we're talking about with this. Now, this can be true especially with stocks. With bonds, it's usually buy, hold, or sell. I don't hear much about people shorting bonds. Yeah. But when interest rates are rising, that means that if you own a bond and you bought it here and the interest rates go up, people can buy bonds with higher interest rates. They're not going to like your bond. They'll only pay you a discount on it. You will lose face value. That's what happened to Orange County. On the other hand, if the interest rates are going down, then your bond will go to a premium because people can't get as good a deal on another bond, and they will pay you extra above the face value. And see, interest rates were going down in the 80s. And so the financial manager there and many others made wonderful amounts of money on the long-term bonds because they bought them and the prices of the bonds went up, so they bought more. They would borrow against those bonds to buy more, and the prices kept rising. But when interest rates turned around and started going up, then their bonds went to a discount, And instead of holding it through the whole thing and waiting until the interest rates came back down, because they always cycle, they were forced by the media or the scandal of the whole thing to sell out at a lower price, and therefore Orange County incurred a loss.
So they should have held on to the bonds they had, you're saying, instead of
I don't know.
as well
I
as
don't know how
selling,
long it
or
will take before the interest rates will cycle back down. The cycle on interest rates can run, you know, for 10, 12, 15 years sometimes.
That has a lot to do with what the Fed's doing too, obviously, because they control the prime rate and all of those things. So, and they're so worried right now about inflation. Seems to be their number one worry at this point. It seems like every time there's good economic news, they want to raise interest rates.
That's
so
right.
It's a whole different ballgame
well,
than we had.
Inflation is very frightening to those of us who are retired.
Right, exactly. True, yes.
On a fixed income, inflation is very frightening. So here's the thing. I have a whole lecture on interest rates and inflation. We could spend an hour just because I always did in the classroom.
It's a large subject.
And to give the students the rule of 72. If you divide the number 72 by the rate of interest, it tells you how long it will take the principal that you invested to double. So if you buy something and it's earning you 8% and you let it just accumulate, 9 years from now you'll have double the amount that you invested. I think you've got the idea.
Right.
But this is a very powerful tool and helpful. Now, some of the other things on technical. A friend of mine by the name of Edmund Menace, who is probably one of the absolute most respected people in the financial circles, called me one day and said, Earl, I've been interested in doing a clustering project. I said, what's clustering? He said, I want to know which industries' stocks move in harmony with which industries' stocks. And why they apparently have no connection with one another, but they seem to move together in the stock market. And so that launched me, with your permission, on a project that it took us 5 years to key punch the data of the Barron's Group stock averages.
How many pages is that?
Well, let's put it this way. It's not the pages. There are 35 years of data weekly on 55 indicators. And
so
I took these and I used them in the forecasting class. We had the students take this information and say, okay, what moves with what and why? And it happened that one of my students was the head programmer of a very major financial company, and he fed this data in, and he came back and he says, I want you to know it took 1,800,000,000 calculations to run through this little thing one time. I said, man, my little PC at home, he said it'd still be grinding 8 years from now. But anyway, what was kind of fun, we got the correlations of the various industries, and for example, we found that the Barron's Group 24 leads the Dow Jones Transportation Average by 1 week. Well, we could forecast the average using the group, but one that's more interesting, Barron's Group 12 leads Barron's Group 14 by 4 weeks. And it did that 96.9764% of the time for 35 years through 8 market cycles. So it gives us some predictability. So this is one of the little juicy items. Barron's Group 12 happens to be beverages, which leads the grocery stores.
With research. We have only a couple of minutes left. I want to talk about public finance a minute because I know you brought something that's pretty interesting. We're kind of running out of time. So
okay.
This is an area that probably the government needs a lot of financial consultants.
Well, what happened, Bob? I did my doctoral dissertation on California's public finances, and we updated it. So we have the data running from 1949 through 1992, which was the latest. And what I did the population statistics, the personal income, and then we did assessed valuation and taxes levied. Now this was on property, and the big thing that you hear is Proposition 13 did such wonderful things for everybody. It was passed right here in 1978, and you see the peak, and then for a year or so it went down. But since then...
Now this is what, assessed valuation of property?
That's what the county assessor comes in and assesses your property, personal and real property at.
So the property values went down temporarily is what you're saying?
The assessments went down.
Assessments, okay.
Now, there's a big... this is a whole lecture in itself, with your permission. I did the assessed valuation to show it has skyrocketed, even though Proposition 13 was designed to try and hold it. Now they levy the taxes on this assessed value, and excuse me, this is government receipts. Here's taxes. The taxes have gone from this level to where we're hitting the California population with this much in taxes, which is
Are those property taxes?
60 billion.
Or other kinds of taxes?
Primarily taxes, property, primarily.
Property, okay.
But we did include the state in this, which does have the income tax and the sales taxes, which go for state and
We have
county.
about 30 seconds, I'm told.
Okay.
So.
Here are the government receipts, and you can see that there has been an almost consistent growth trend going straight up. And the government payments. This is the amount that the government spends, and then we have the interest expense that the California taxpayers are bearing, and it's up over $2 billion, roughly $2 billion a year.
Well, you can see that that things are going up even though we have Prop 13. So even though it did lower the...
and the indebtedness that we have in California has climbed up.
Thank you. Earl Beecher, thanks for joining us. Obviously, we need about another 2 hours to talk about this. Thanks for being with us.
We could get into this one.
Thank you. Thanks for joining us. We'll talk to you next time.